So Olivia is interested in taking out a reverse mortgage on her. Oh, we're talking about finance, by the way. So Olivia is interested in taking out a reverse mortgage on her home. What is the minimum age at which a person qualifies for a reverse mortgage? What do you guys think? Is it 62, 68, 50, or 55? You guys know this one right away. Yeah, it's 62, right? 62. So what is a reverse mortgage? A reverse mortgage is when I'm borrowing the equity from my home, usually when I've got lots of equity. It's kind of like getting me through my retirement years. I'm now borrowing against my home, but what's happening is instead of me making a monthly payment for my mortgage, the lender is paying me once a month, right? So that's how a reverse mortgage works. All right, next question. Fred is buying a home. His lender is examining all of his monthly expenses. The lender wants to know about his housing expenses, his student loans, his car payment, and his monthly payments to his credit card issuer. His lender calculates the ratio of these as compared to his monthly gross income. What do we call that? You guys, a second to think about it. What do we call that? So he's looking at everything. They're looking at the student loans. They're looking at his housing expenses. They're looking at his car payment. They're looking at the whole enchilada. Is that debt service, front end ratio, back end ratio, or is APR, annual percentage rate? What do you guys think? Ooh, I've got some people stumped on this one. Good. This one's a little bit tricky. So this is called the back end ratio. The back end ratio is when they look at all of my expenses. The front end ratio was when they're just concentrating on my housing expenses, right? So a lot of lenders use the two ratios where they qualify me based on, can I afford just this housing? And also not just can I afford the housing, but can I afford the big picture, all of my debt? Does it meet the requirements? So this is called back end ratio. Jenna's property is losing value. What is this known as? Jenna's property is losing value. This is known as depreciation, income capitalization, deferred gains, or appreciation. If our property is losing value, we know that that's depreciation. What's the opposite of depreciation? Appreciation, right? If we're gaining value, we have appreciation. All right, next question. The change in dollars for the use of money for a period of time. In a sense, the charge in dollars. The charge in dollars for the use of money for a period of time. In a sense, this is known as the rent paid for the use of money. Is this interest? Is this dividends? Is this assessment? Or is this margin? When the lender is charging me to use their money, that's our interest, right? And our interest rate is the percentage of money, or this percentage that they're charging me to use their money. Now, let's say that I had, I got to get my calculator out for this one. Sorry. So let's say that I have a $300,000 house, a $300,000 loan, I should say, a $300,000 loan, and the interest rate is 6%. How much interest would they charge me per year if I have a $300,000 loan at a 6% interest rate? What do you guys think? $300,000 loan at a 6% interest rate. How much would they charge me per year for that? That's $18,000, right? Yes, it's the loan amount times the interest rate and gives us our annual interest amount. And then, of course, if we want to find monthly, we would just divide that by 12. Awesome. All right, our next question. Which of these agencies is not part of the secondary mortgage market? Is it Fannie Mae, Freddie Mac, Ginnie Mae, or Norello? Yes, Norello. For you New Yorkers know what that is, but Fannie Mae, Freddie Mac, Ginnie Mae, they're all part of the secondary mortgage market, right? So the banks make a bunch of loans, they package up those loans, they sell them off to investors, and the middlemen that make those connections are Fannie Mae, Freddie Mac, and Ginnie Mae. Yes, awesome. So blank loans are federally backed mortgages designed for homeowners who may have lower than average credit scores. Are these conventional loans, land contracts, FHA, or purchase money mortgages? What do you guys think? Conventional, land contracts, FHA, or purchase money mortgages? All right. Yes, FHA. Now, that doesn't mean that FHA is just for bad credit, right? I mean, we can't have really, really bad credit and qualify for an FHA loan. We still have to meet the minimum scores. Now, they say that FHA minimum scores, you always hear that 580 is the minimum. But in reality, most of the people who get approved for the FHA loans have about a 620 or above. Doesn't mean I haven't seen it come in lower, but sometimes they can. Becky's rental income after expenses best describes as a cash throw off, effective gross income, net income, or potential gross income. Her income after expenses. It's her rental income after expenses. Everybody knew this one. Yes, net income. Remember, we have potential gross income, which is how much money we would have coming in potentially if all of our units were occupied and everybody was paying us all the time. Then from there, remember, we take out our vacancy and collection losses and what we effectively collect from our folks, right, from our tenants is our effective gross income. And then from there, we take out our operating expenses. And those operating expenses are like things like keeping the building running, keeping the lights on, keeping the utilities going, paying the property manager, all those things. And what we're left with in the end, our actual money that we put in our pocket is our income, is our net income. Remember, that's all important stuff to know for your income cap approach. All right. Robert signs a document that outlines who the borrower and the lender are, as well as the amount be repaid and the terms and interest rates at which he will repay his debt. What is Robert signing? Is it a credit report, a contract for deed, a promissory note, or a truth and lending statement? What do you guys think? Yeah, the promissory note. I promise to repay the money, right? Promise to repay the money is the promissory note. Yes, definitely. All right. Okay, the next we have discount points allow borrowers to what? Their interest rates by prepaying interest. Is it increase, lower, redeem, or lock in? Discount points allow borrowers to blank their interest rates by prepaying interest. Yeah, they would be able to lower them. Remember, sometimes we call buy downs, right? We talk about buy downs when discount points, we're buying down our interest rate. We're paying some of the interest up front as prepaid interest, and then that lowers the amount that we have to pay over time. So for the lender, they're happy either way. If we do discount points and we pay some of the interest up front and less over time, or if we just pay it all over time and none of the points up front, in the end, they're going to collect the same amount from us. A short-term loan, often referred to as a swing loan, that is used by a borrower until permanent financing becomes available. Is that index mortgage, temporary mortgage, bridge loan, or boot? A short-term loan, often referred to as a swing loan, that is used by a borrower until permanent financing becomes available. Index mortgage, temporary mortgage, bridge loan, or boot. Oh, you don't know this one? Okay. This is the bridge loan. And these used to be a lot more popular when I first started years ago and don't hear about them as much anymore. So let's say I have my house listed for sale for $500,000 and I have a lot of equity in my house. And I see that Chelsea's house is for sale and I really want Chelsea's house, but I don't want to wait for mine to sell first. So what I could do is I could take out a bridge loan, temporarily borrow the equity from my house that's on the market right now, and then go ahead and buy Chelsea's house. And then when my house sells and closes, pay back that temporary financing. That's what a bridge loan is all about. All right. Next, we have Gary has served proudly in the U.S. military and has recently retired. He is purchasing a home using a VA loan. He has been issued a certificate by the VA establishing the amount of eligibility he has for a VA loan. This is called is it a certificate of reasonable value, certificate of eligibility, amortization schedule, or conventional pre-qualification? Which thing is Gary going to hand to his lender to tell the lender how much he's qualified for? Yeah, the certificate of eligibility for the VA loan. The VA borrower will get a certificate of eligibility that says how much he or she is qualified for to borrow from the VA, right? And a lot of people have this misconception that you can only have one VA loan out at a time. But if a person is being relocated from one place to another, their prior house hasn't sold, as long as their certificate of eligibility is enough to cover both, at least this is the way it always used to be, then they could qualify for the two loans. And then when the other house sold, they would just pay off that and regain their eligibility. Yeah. The certificate of reasonable value. Good question. Ori asked, what about a certificate of eligibility? So a certificate of eligibility is, or excuse me, the certificate of reasonable value. So the certificate of reasonable value is who gives us the certificate of reasonable value? Does anybody know this one? Where does that come from? Who would give us the certificate of reasonable value? Whose job is it to determine that for the VA? Anybody know this? I might have stumped you guys a little bit. I've asked you some more, wasn't I? Good. The appraiser. The appraiser would tell the lender and the government how much the reasonable value is for the house. So if I'm taking out a VA loan and I am going out and making an offer on your house and putting a contractor on your house for $300,000, if the certificate of reasonable value comes in below that, we've got a problem, right? Because we know that VA loans are supposed to be, their whole thing is that they're zero down. But if the appraisal doesn't come in high enough, the lender is going to cap that loan at whatever the certificate of reasonable value is. They're not going to take the risk to go above that. So that's a big deal for the VA buyers, right? All right. The blank is the market where borrowers can obtain a mortgage loan from a primary lender, such as a bank, mortgage brokers, mortgage bankers, and credit unions. The blank is the market where borrowers can obtain a mortgage loan from a primary lender, such as a bank, mortgage brokers, mortgage bankers, and credit unions. Is it the primary mortgage market, the home equity mortgage market, the title market, or the secondary mortgage market? This is the borrowers going straight to their lender, right? The consumer. So that's the primary mortgage market. Good job, you guys. Now, we've got the primary borrower taking out his loan. Then what? Then eventually, many times, the bank will package up his loan or her loan along with many other ones, and they'll resell those loans on the secondary mortgage market. See that transition there between the two. All right. The seller in a land contract is known as the trustor, the vendee, the vendor, or the beneficiary. Remember, yes, this is the vendor. Who's the vendee? The vendee is the buyer. Right. The vendee is the buyer. Very good, you guys. Now, that doesn't mean that vendor and vendee can only be used for land contracts. It's just more common. Like we use that a lot of times when we're talking about land contracts. This term refers to the effective annual rate of the cost of borrowing, which includes all finance charges such as interest, prepaid finance charges, prepaid interest, and service fees. Is it margin, annual percentage rate, indexed, or the mixed rate mortgage? What do you guys think? Yeah, this is the APR, right? The true cost of borrowing. We always refer to this APR as the true cost of borrowing. So it includes other things besides just the interest rate. It includes the finance charges, the interest, the prepaid finance charges, any of the prepaid interest, any of those service fees, all that stuff together comes together to form our APR. And why is it important to know our APR? Because we want to be comparing apples to apples when it comes to financing. We want to be comparing the true cost of one loan to the true cost of another to see which one's better for us, right? If we just know the interest rate, that doesn't always tell the full story because there could be lots of other fees that are hidden there. All right. With only a week to spare before the foreclosure on his home, Jim suddenly inherits money from his rich uncle. He rushed a payment to the bank to cover all the past due payments and the late charges, as well as the accumulated attorney fees on his home. Jim was able to save his property under which right? Is it caveat emptor, revocation, the statutory right of redemption, or the equitable right of redemption? Caveat emptor, revocation, statutory right of redemption, or the equitable right of redemption? Yeah, this is the equitable right of redemption because it's before the property hit the auction block. In some states, we have a statutory right of redemption. The statutory right of redemption is the amount of time after the property has been auctioned off at a foreclosure auction that we have to come back and still save the property. Some states allow us only to do it before the auction. Some states allow us some time after the auction too, and that's the statutory right of redemption. So know the difference between those two, right? Equitable is before, statutory is after. Okay, next, a blank is a kind of mortgage that a lender originates and retains instead of offloading on the secondary mortgage market. Is this a signature loan, a personal loan, a portfolio loan, or an index and margin loan. This is the one that they're going to keep and retain and service in their own bank. What do you guys think? Ooh, I got some people stuck on this one. The portfolio loan. It's part of their lending portfolio. They're keeping it in house. A lot of credit unions and small banks keep and service a lot of their own loans. So just because the bank makes a loan doesn't mean they have to sell it. They can keep it and service it themselves. And they call those portfolio loans. It joins their loan portfolio. Very good, you guys. All right. A mortgage borrower paid interest to their lender at the closing table. This lowered the amount of interest they will pay over the life of the loan. What is this prepaid interest called? Is it a prepayment clause? Is it debt service? Is it net income? Or is it discount points? A mortgage borrower paid interest to their lender at the closing table. This lowered the amount of interest they will pay over the life of the loan. Yes, discount points. You guys recognize that one straight away. Discount points. Now, how do we calculate discount points? What's the formula? 1% of the loan amount. Be careful with this one because it's not 1% of the purchase price. It's 1% of the loan amount per point is the cost. So if I have a $300,000 loan and I'm paying 1 point, I would pay $3,000. If I'm paying 2 points on a $300,000 loan, I would pay $6,000. Sorry, I had to do the math in my head there. Okay, so 1% of the loan amount per point is the cost. Good job, guys. After applying for a loan and being approved, Kyle was given a statement of total interest being paid over the life of the loan. Which federal statute requires a lender to give Kyle this statement? Is it the Federal Fair Housing Act? Is it Regulation Z? Is it the Fair Credit Reporting Act? Or is it the Equal Credit Opportunity Act? Yeah. Regulation Z, truth in lending. Yeah, right. Exactly. We need to know this loan is truly going to cost us, right? Truth in lending. Now, not that this is the answer to this question, but let's talk a minute about the Fair Credit Reporting Act. What does the Fair Credit Reporting Act let us do? What's it designed for? So if we have something on our credit that's not supposed to be there, the lender has to remove that from our credit. If we write to them and say, hey, this is on my credit, it's not supposed to be there, and it happens, I file this dispute, then the lender has to either prove it to me or take it off. So yeah, they can't just say, oh, I'm just going to slap this on to Annabelle's credit report and just leave it sit there, right? If it's inaccurate, they have to remove it. Very good. Very good. All right. Heather is told that she will be expected to make PITI payments on her mortgage. What does that stand for? What does PITI payments stand for? Yeah, principal, interest, taxes, and insurance. PITI, principal, interest, taxes, and insurance. Now, you guys, the lender always says, oh, we're doing this for your convenience, right? We just want to make it really easy for you just to pay one payment and we'll take care of it all. But now, if they really cared about my convenience, they would include my direct TV bill and my car payment in there, right? They would just let me pay everything to them and then they would just disperse it wherever. But then that's not what happens in real life. Why do you think that the lender is collecting that property tax and insurance and hanging on to that money to get those things paid? Why are they doing that? What do you think their real motivation is? And it's to protect their asset, right? It's protect the collateral. So they want to make sure that we're paying our property taxes because they don't want the government to foreclose on the collateral for unpaid taxes. They want to make sure we're paying our insurance so that we don't, have our house burned down if the Christmas tree catches on fire and then they lose that collateral. So yeah, they're going to do both. They're going to make sure that we get those things paid. And that's why most people who have mortgages have PITI payments. I have seen some loans where they don't include that, but it's rare. And it's only a couple of local banks that we have that don't. Most of them do. All right. The cost a borrower pays to cover the expense of processing a loan is known as, is it the origination fee, the buy down point, the prepayment penalty, or the actuary fee? The cost a borrower pays to cover the expenses of processing a loan is known as a what? And yeah, that's the origination fee. They're originating the loan. They're putting together the loan. The origination fee is the expense there. Yeah, for sure. That's how they charge it. And sometimes they would charge us like a point for the origination fee. They'd say, oh, for your origination fee, it's 1 point. So would a seller prefer to receive a pre-qualification letter or a pre-approval letter from a buyer? What do you guys think? Would a seller prefer to receive a pre-qualification letter or a pre-approval letter from a buyer? Is it neither? Is it pre-approval letter, pre-qualification letter, or either one? Who the heck cares? What do you guys think? The pre-approval letter. Why? Why is it the pre-approval letter? So the pre-approval letter is stronger than the pre-qualification letter. Let's say that William came in and talked to me about his finances. He said, "Look, these are my monthly bills roughly. This is how much money I make." And I kind of did a cursory little mathematical calculation and told him what I thought he would be pre-qualified for. That's a lot different than pre-approving him, where I actually check out and make sure that William is not full baloney, right? The things he's telling me are true, that this is truly his income, this is truly his debt. The pre-approval letter usually tells us that they've checked some of this out. Be careful with pre-approval letters in our real life, because I have seen really bad pre-approval letters where they're like, "Oh, yeah, we're pre-approving you for this loan, but it's contingent upon us checking everything." Well, that tells me they haven't really done their due diligence, right? So we want to make sure, what are the caveats to this pre-approval letter? Extinguishing a debt by equal payments of regular intervals over a specified period of time is called capitalization, term ownership, amortization, or gross income multiplication. So capitalization, term ownership, amortization, or gross income multiplication. Yeah, amortization. If I have a fully amortized loan, how much do I owe at the end? Fully amortized loan, what do I owe at the end? Nothing, right? It's fully amortized. If I have a partially amortized loan or an interest-only loan, I still have a payment due at the end. And that big payment that's due at the end of what I didn't get paid over the life of the loan, what do we call that? We would call that the balloon payment, right? Very good, you guys. So this is a good question, and I want to talk about this real quick. So it was asked of me, when you use discount points, would it be after the down payment as well? So remember, discount points and down payment are two separate issues. The down payment reduces how much I owe on the house, right? If I buy a house for $300,000 and put a down payment of $100,000, then I'm taking out a loan for $200,000. Makes sense? But if I'm paying discount points, I still owe the same amount on the loan. It's not reducing the loan amount. It's not paying down the loan. It's just prepaid interest. So it's less interest that I pay over the life of the loan because I'm giving a chunk up front. Hopefully that helps everybody. So in a lien theory state, what is the lender called? Is it the beneficiary, the mortgagee, the trustee, or the mortgagor? In a lien theory state, what is the lender called? What do you guys think? Is it the trustee, the beneficiary, the mortgagor, or the mortgagee? Yeah. So the mortgagee, okay? Remember our E and OR endings. The mortgagee is the lender. The borrower is the mortgagor, right? So next we have an instrument used to transfer title from a trustee to the equitable owner of real estate. When title was held as collateral for security for a debt, is most often called a deed. Is it in lieu of foreclosure, of reconveyance, of trust, or of redemption? What do we call that deed when we're transferring that back? Right. A deed of reconveyance. They're reconveying the deed back to me. Sally has applied for a loan. Her lender has given her a statement that she will pay $325,000 in interest over the life of the loan. What federal statute requires the lender to provide that information to her? Is it Regulation Z, the Civil Rights Act of 1866, the Statute of Limitations, or the Equal Credit Opportunity Act? Which one of these federal laws makes them give that info? Yeah, Regulation Z. Now, tell me, I know it's not the answer to this question, but tell me, the Civil Rights Act of 1866, it covers one thing. What's the protected class that the Civil Rights Act of 1866 covers? Race. Very good, you guys. And there are no loopholes. There is no ignoring this. It is never, ever, ever okay to discriminate based on race when we're talking about housing, right? We know that because the Civil Rights Act of 1866.